Hello friends, I'm Ritesh here from Tech Speaks YouTube channel, and in this video I will be discussing about the tax implications on gains from mutual fund investment. Friends, if you are watching this video for the first time, I will request you to subscribe to my YouTube channel as well as my Tech Speaks blog, as I keep posting content related to personal finance on my blog as well as my YouTube channel. So without further ado, let's get started. Friends, let's begin with classification of gains from investment in mutual fund. Gain from mutual fund scheme may be classified as short-term capital gain or long-term capital gain depending on the holding period. Plus, you have the dividend distribution payout system where regular dividend is paid out to the investor from the mutual fund scheme. This is recently renamed as the income distribution cum capital withdrawal system. So under which you get regular dividend payouts. Now, when we talk about the tax implication on the different mutual fund schemes, we have to understand that based on the holding period and the nature of investment, the equity mutual fund schemes are taxed differently. So first we talk about equity oriented mutual funds. Now these are the funds which have an exposure of 65% or more in equities. Now these funds include equity mutual funds like balanced funds, ELSS mutual funds, which are the tax saving mutual funds, and so on. So any fund which is having 65% or more exposure to equity are known as equity oriented mutual funds, and they have a different system of taxation based on the holding period as compared to non-equity mutual funds, which includes debt oriented funds, liquid funds, money market funds, and so on. So we will be discussing this later on in this video, but it is very important to understand the different types of mutual fund schemes which are in the market and the tax pattern for the same. Furthermore, the mutual funds offer two options to the investors. One is a growth option where the return which you are generating is added back to the investment and it continues. While in the another scheme, what happens is that the mutual fund scheme regularly announces the dividend payout and it is paid to the investor. So again, the tax pattern for both will be different, which we will discuss rather later. Now friends, earlier I had said about the holding period. Now based on the holding period, the mutual fund gains are taxed. So when we come to equity oriented mutual funds, the minimum holding period is of 12 months to qualify as a long-term capital gain. And anything less than 12 months is considered as a short-term capital gain. Whereas for non-equity mutual funds, the minimum holding period goes up to 36 months to qualify as a long-term capital gain, while anything below 36 months is considered as short-term capital gain. Now we will build on this and try to understand the income tax implication or the tax implication on capital gains in the next slide. When we talk about the tax implication on mutual funds, I have divided them into three parts. First is the equity oriented mutual funds, then we come to the non-equity oriented mutual funds, and last we come to the income distribution cum capital withdrawal mutual funds, where you get regular payout in form of dividends. So coming first to the equity oriented mutual funds, LTCG, which is the long-term capital gain up to 1 lakh, is exempted from tax for the particular financial year. So if you are making a capital gain of 1 lakh, which is regarded as a long-term capital gain, so it will be exempted from tax. However, you have to declare this income while you are filing your return. When we talk about LTCG, which is the long-term capital gain in excess of 1 lakh, that will be taxed at 10%. So if you are making say 1.5 lakh of long-term capital gain, then the 50,000 which is there in excess of 1 lakh will be taxed at 10%. While for short-term capital gain, the tax rate is fixed at 15%. Remember, a cess will also be charged apart from the tax rate on the income tax or the capital gain tax which is payable. Now, when we talk about the non-equity oriented mutual funds, LTCG will be taxed at 20%, but you will get the indexation benefit, which is the adjustment for the inflationary trend. Now, I will briefly discuss it in the next slide. What is this indexation benefit? So just keep in mind that for non-equity oriented mutual funds, the LTCG will be at 20% with indexation benefit. Whereas for short-term capital gain, the gain which is made by through the investment will be added to the income of the investor and will be taxed accordingly with the tax slab under which the individual falls. So say you have made a short-term capital gain of 1 lakh rupees and you have an annual income, say a salary income of 6 lakh rupees. So this 1 lakh will be added to your 6 lakh rupees, which is your salary income. So on 7 lakhs, you have to pay tax as per the tax slab. So this is about the non-equity oriented mutual funds. Now we come to the dividend payout model, which is renamed as income distribution cum capital withdrawal method. Under this, again, whatever the dividend is paid out will be added to the income of the investor and will be taxed accordingly. Now again, as per the income tax slab rate, it will be taxed. Friends, I spoke about the indexation benefit for non-equity oriented mutual funds in the previous slide. Now it is the adjustment which is done for the inflationary trend. So the cost of inflation index, which is the CII, is used to determine the appreciation in value of an asset due to the inflationary trend. Now the cost of inflation index is used to calculate the long-term capital gains from sale or transfer of capital asset. The base year was shifted from 1981 to 2001 and the budget 2017. The base CII in 2001 was set as 100. Now I have already shared the formula for calculating it. Now understand, say you have made investment in mutual fund, which is non-equity mutual fund, non-equity oriented mutual fund in 2015, and that point of time the CII for the purchase year will be taken, and if you make the sale say in 2021 where the CII for the sale year is 317, so it will be 317 divided by the purchase year in 2015, whatever was the CII, into the actual purchase price. So this is the formula by which the calculation is done, and based on that the tax is levied, the capital gain tax on non-equity oriented mutual funds, which is for the long term. Friends, with this we come to the end of this video. I hope you found this video to be helpful. In case you found this video to be helpful, I will request you to like, share and subscribe to my YouTube channel as well as my blog, as it helps the channel to grow. Friends, do keep in mind that it's just that I'm sharing my views on my blog as well as my YouTube channel. I will request you to consult your financial or tax advisor before taking any decision related to your finance, because do keep in mind it's your money and you should be very careful with it, with your investment as well as your tax perspective. So that's it from my end. I will take your leave and I will thank you for watching this video this far, and I will come very soon with a new video. Till then, bye bye.